Welcome to our webinar. 567 Workshops is proud to present our guest speaker, Dan Pascone. Dan Pascone grew up in the financial service industry dating back to his college days, where he worked with a high net worth financial advisor. For the first 10 years of his career, he worked at Prudential Financial in the retirement business, where he called on and supported financial planners and professionals. Dan changed roles in 2016, where he observed the need for a solid financial plan, which prompted him to start his own practice to help serve individuals facing key life events. Dan founded Tailored Sense, where he and his team apply that approach to a community of clients all over the United States. Dan has a bachelor's degree and MBA from Sacred Heart University in Fairfield, Connecticut, where he currently serves on the board. With that, we want to allow a moment for others to join and get set up. Thank you for your patience, and Dan will begin the presentation momentarily.
Thank you, Taylor, and hello, everyone, and thank you so much for joining our educational webinar today, focused on taxes and retirement, and specifically how tax planning changes through the 4 stages of retirement. As Taylor mentioned, my name is Dan Pascone, and I lead a firm called Tailored Sense, and I'll briefly talk to you about what we do in a moment. But first, let's go over the logistics of today's program. This is a live webinar, and we'd like to make it as interactive as possible. So we are going to ask that you all participate in a couple of ways. First off, we will launch several polls throughout the presentation to gauge you, the audience, on several key topics pertaining to the content. I will notify you when the polls launch, and I'll ask you to give your best answer. So we're going to have some quizzes out there. Be ready for them. Second, we invite you to send any questions that you have throughout the presentation through the Q&A function, which can be located in the bottom right-hand corner of your webinar screen. So check it out right now. If you don't see it, maybe search for that chat bubble icon and then the section located called Q&A, and that's where you'll be able to send questions through. And with me for today's program is Taylor, who you just heard from, and she is our webinar coordinator, as well as Rich Wolf, who is our Chief Client Officer at Tailored Sense. I will stop periodically to field some questions live, but Rich is also very knowledgeable on today's content, and he will do his best to answer as many questions as possible through the Q&A function while I am presenting. Only Rich and I can see the questions that you send in, so don't be shy and send away. We want to hear from you. We want to be conscious of time, so there may be some questions that we're not able to get to during the presentation, but we will absolutely cover any and all questions in part 2 of the program, which I will explain in a bit. And speaking of time, our promise is to be done with the program within an hour so we can get you all back to your busy lives. So before we start, I think it's important to tell you a little bit about me and what makes me qualified to speak on today's content. At Tailored Sense, our mission is to provide educational resources and build custom financial plans to help hardworking individuals and families accomplish their life goals. Today's program is a great example of the educational resources that we seek to provide. And because of that, I'm sitting here in my library conference room today, because we believe that education is so critical to making the right financial decisions, which is why we regularly conduct programs just like this, as well as a host of other educational resources that we share to help the folks that we come across learn and get better about financial planning. I am particularly passionate, though, about today's content because proper tax planning is one of the key components of a custom financial plan. And in my opinion, no other component of retirement planning will have a greater impact on your overall wealth than tax planning. And it's this specific area where we see most individuals and families making mistakes and costing themselves unnecessary portions of their hard-earned savings. Now, we believe that all Americans need a custom financial plan built specifically for their situation and goals. And we work with a community of amazing clients to do just that. Now, here's a photo of me with one of our amazing clients. This is Frank and Beck. Say hi to Frank and Beck. We have worked with them for a number of years to help them develop and execute their financial plan and ultimately to help them reduce taxes in retirement. And Frank actually just recently retired after 48 hardworking years, and his company just threw him a retirement party. I had lunch with them recently, and they were nice enough to save me a bottle of champagne from that party as a testament to the work we did together to help them to accomplish their goals. And you can see the champagne and the retirement sign here, which was a very, very happy and proud moment for me. And I know that it was a very, very happy time for them as well as they're entering into their retirement years. And I show you this because I think it is so important to have a real purpose in what you do. And this right here is why I absolutely love what I do. Now, I mentioned that there would be a part 2 to today's program. There's a lot of content today, and we've found after doing many of these sessions that in order to get the most out of the program, it's best to have a follow-up meeting with each participant to answer any specific questions that you have and to assess your individual situation. We call this meeting the Financial Plan Assessment, and it's done virtually and lasts about 30 minutes. So throughout the presentation, Taylor will flash a link, a virtual link to my calendar. You should see that popping up now in the bottom left-hand corner of the screen. There it is. And you can click the link to view my schedule and schedule a time and a day that the assessment works best for you. If you click on that link, it's important to note that you will be directed to my calendar, but you won't be removed from the webinar. Okay, so you can do it now if you so choose, or we're going to give you several options and times throughout the program to be able to click on that link and schedule your financial plan assessment. But let me be clear, there is no cost to scheduling this meeting, and you are under no obligation to work with us. This program and the financial planning assessment are meant to be educational, and we love doing them because it helps us to further our mission. Lastly, at the end of today's call, I will share several resources with you that will help you to make the most of today's program and help to navigate the waters of taxes and retirement. So make sure you stay on to the end because you want to make sure you get access to those resources. So with that, let's talk about taxes, everybody's favorite topic, right? I actually want to start with a very short video that I think does a great job of illustrating how we all feel about taxes.
Oh my gosh.
Where's all your money gone, Daddy?
Taxes. 9, 10, 11. Let me fix my houses. But it's okay. It's part of the game. No, it's not. It's not fun.
It's not fun to what?
It's the worst part of the game.
Oh, it's what?
Taxes.
I love that video. How spot on is that? Kids always have a way of telling it like it is, right? It's funny. I have a son who's about that age. That's not my son, but I have a son that's about that age. And I can tell you that's exactly how he would react to paying taxes in the game of Monopoly. This boy's quote really stuck out to me, though. It's the worst part of the game. And since you're here today, you probably believe that taxes are the worst part of the retirement game. And although we know that taxes are one of life's great guarantees, our goal today is to help you to minimize them so that you can win the game of retirement. So now before we dive into our presentation, we're going to warm up with a little tax brain teaser where you all will get a chance to participate. So let's talk a little bit about Bill. After working hard for his entire adult life, Bill, who's 65, has finally retired, and he loves music. So he's going to more concerts than he ever has before, now that he has the time in retirement, which is great for Bill. Bill has $41,825 in taxable income, which includes $25,000 of Social Security benefits this year. And as you can see, Bill's $41,825 of taxable income puts him in the 22% tax bracket because it's more than $41,775 and less than $89,076. So toward the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson play in Austin, which I bet that was a great show. Well worth the $1,000 out of the IRA. So the question is, though, how much was he taxed on the $1,000 distribution? So here's where we're going to launch our first poll. Question is, how much do you think Bill will owe? We're going to keep it simple. You've got two options. Does Bill owe $220 in federal income taxes, or does he owe $407? Give a brief moment for you all to answer that. Maybe do some quick calculations. All right, the answers are flooding in, so thank you for your participation. And it looks like most of you are saying $220. And that is the logical answer because every dollar of IRA money that he pulls out, he pays 22 cents in federal income taxes. Therefore, he took out $1,000. He should pay $220 in federal income taxes, thus being in the 22% tax bracket, right? Pretty simple. Well, that's actually incorrect. So congrats to the few of you, it was a few, who said that he owes $407 in tax. You are actually correct. Bill was assessed a 40.7% federal tax rate on that additional income. Doesn't make any sense. Let's talk about why. Thanks to the madness that is our tax code and the unique formula that determines how your Social Security benefits are taxed, Bill owes $407 on that extra income, which is really completely shocking, right? I mean, a top rate for a single person, a top tax rate for a single person is 37%. And that rate doesn't start until you're over $510,000 in annual income. How can he pay a much higher rate with much less income? Doesn't make any sense. But here's the thing. It's the tax code. And just like the young boy in the video illustrated, it doesn't make any sense. Later, I'll explain exactly why Bill faces that tax bill. But for now, the important thing to realize is that when it comes to taxes, the obvious answer is not always the correct answer. In fact, it rarely is. Now, you may be wondering, why is a financial planner giving a presentation about retirement tax planning? While we are not a CPA, what we do is help people understand how the tax code and other rules can impact their financial planning and investments. And then we develop a plan to take into account many of the odd things that people encounter, especially around taxes and retirement. Now, everyone's tax situation is different, which is why we work closely with a network of CPAs to help partner and properly plan with our clients. So let's move on. It is certainly a new complex world. And our goal here is to help you to understand the retirement distribution game or spending assets in retirement and how that is much different than the accumulation game when you're saving for retirement. Chances are you've been in the accumulation phase of your life for several decades and you've been working hard to save money. But now, as you enter and prepare for retirement, you enter into an entirely different phase, the distribution phase. And this phase has new, strange rules that can catch people off guard. And along with those rules, there are often many changes in your own personal life that can have a big impact on your taxes too. For instance, your children may have grown, and that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. And if you're already retired, you may no longer be receiving tax-free employer-paid medical insurance. And if you stopped working, you may no longer have the ability to stash away income in a 401k or similar plan to reduce your annual tax bill. And at some point, if not already, you'll start taking Social Security. And if not sooner, when you reach age 72, you'll have to start taking required minimum distributions from your retirement accounts. And the list goes on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. And understanding what these are and how they can impact you can be absolutely crucial to your long-term wealth. So that brings us to a simple statement about the problem that we're here to discuss. Simply put, people often pay more in taxes in retirement than they expected because of a confusing system that treats various income types differently and contains hidden taxes and penalties. Because your tax exposure will change throughout the 4 stages of retirement, you need a strategy that anticipates both traditional taxes and possible taxes, surcharges, and penalties related to Social Security, Medicare, and other income sources. That means you'll need an informed and proactive plan that addresses how you create your income in retirement. And my goal today is to introduce you to the major aspects of such a strategy and show you the challenges we all face, and then explain what makes up a workable solution to our retirement tax problem. Before we go on, let's talk about the 4 stages of retirement that we'll discuss throughout the presentation. Now, these are just a rough framework. Obviously, your experience may differ. First off, we've got the pre-retirement, the final work and save years, typically ages 50 to 60. Next, we've got the early years of retirement, age 60 to 70, call them the go-go years. Love the go-go years because people often have grand plans for the go-go years, like traveling, volunteering, starting new hobbies, maybe working part-time, and certainly spending more time with family. That's a great time. Next, you reach the middle years of retirement, typically 70 to 80. Those are the go-slow years, which brings more financial decisions, such as how to deal with required minimum distributions from your IRAs and other retirement accounts. And then finally, we've got the later years in retirement. And at this point in time, we really want to focus on healthcare because that could be the primary focus of that stage of life. And as you can see, there are a wide range of issues that must be planned for in each phase. And this can be a lot harder than it seems because retirement is full of surprises. And even the best planning will divert from reality at some point because we know that life changes. One future unknown is inflation. Pretty hot topic these days, right? We know how prominent inflation is right now as the cost of our goods and services are growing at an astronomical rate. But the question is, will this rapid inflation continue throughout your retirement? Really tough to tell, but it does need to be accounted and planned for. Now, how about longevity? Many people end up living far longer than they ever expected, especially in this day and age, with all the breakthroughs in Medicare and all the things that come along with that, including medicine and advances. And that requires more money at a time when it's very difficult to work. And so how long do you think you will live? Many people also underestimate how much money they need to maintain a pre-retirement standard of living. And who wants to see their standard of living drop? And then there are healthcare costs, which includes your out-of-pocket payments for services and drugs, plus Medicare and insurance costs, which continue to rise. Now, at this point, you may be thinking, okay, so what's the first thing I need to understand about retirement and taxes? Well, that brings us to our first key. You have to know what your after-tax retirement savings picture looks like before you actually retire. That's the key. Because a $500,000 401k or IRA balance isn't really $500,000. The government has a claim to part of that money because the taxes on those accounts were deferred while they were growing. The government's going to get their share when you're forced to start taking required minimum distributions, as we mentioned, after you turn age 72. And obviously, the higher the tax rate in retirement, the less your account is actually worth. So here's an example. This chart shows you the cumulative after-tax amounts you could expect to receive from a $500,000 IRA, earning 6% per year at various tax rates. Now, as you can see, the lower the tax rate, the more you keep, which is simple in theory, right? But we know that there are a lot of variables involved in that. And by the way, I think it's worth mentioning that this presentation applies to both pre-retirees and retirees. So don't worry if you've already started retirement. In fact, I'm actually curious to see. So let's open it up for a quick poll here. I'm curious how many of today's participants are pre-retirees versus already retired. So take a moment, and that should be a pretty simple question, and send in your response. All right, we've got a bunch of responses coming through. Thank you. This is a group that is not afraid to participate. I love to see that. And it looks like we've got looks like a pretty good split between pre-retired and already retired, which is great. Maybe we even have folks in all 4 phases of retirement. But regardless of what phase you're in, tax planning is important throughout all stages of retirement. Now, you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my health costs. But one thing you need to understand when creating your retirement tax strategy is Social Security and Medicare have their own tax traps as well that you need to plan for. So first off, we'll talk about Social Security and how taxes can impact Social Security. Let's go back to Bill from our tax brain tease. Remember Bill? We want to understand why he paid such a high tax rate on the extra money he took from an IRA to go on that concert trip. Remember, Bill has $38,000 of IRA income, part of his adjusted gross income of $56,525, and he has $25,000 of Social Security benefits. That puts him squarely in the 22% bracket, and he takes the standard deduction. Yet, when he took that extra $1,000 IRA distribution, he got hit with a nearly 41% marginal tax rate on that $1,000 withdrawal. Now, let's break down how that actually happens. First, we need to remember that the only difference between the two scenarios is that Bill has taken an additional $1,000 from an IRA. You can see that in the after concert trip column. He has $39,000 in IRA income. You can see that on the screen. So we see here that by adding the additional $1,000 of actual income, it increased both his AGI and his taxable income by $1,850. That means that for every dollar of income he actually received, he's being taxed at $1.85. How does that make any sense? Here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax-free at the federal level. That's what we always strive to get our clients to. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Okay? Very, very important to understand that. And Bill finds himself in the latter scenario here. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he also adds an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% rate for every $1 of additional IRA income he actually receives. If you do the math on that, it comes out to be a 40.7% real tax rate on the additional $1,000 of income. And that is the so-called Social Security tax torpedo. It can impact single filers and married couples with even fairly modest income during any stage of retirement. And it's one reason that tax planning in retirement is so important. So I think this is a good time to pause and take a question. So I know we've seen a bunch of questions come through. Let me pick out one here for the audience. Okay, this is a good one. This one comes from Jill. And Jill asks, how does when you start taking Social Security impact how much you'll pay in taxes on your Social Security? I think I read that right. And it's a great question, Jill. Thank you for submitting. And the answer is it depends. And that's the answer you get in most complex financial planning questions. It depends on the circumstance. But the best answer I can give you, and the recommendation that we always make, is you need to couple Social Security planning and tax planning together. Okay. Far too often, I see individuals and families looking at Social Security sort of in a vacuum and just planning for, let me get the most out of my Social Security benefits. Now, conceptually, that makes sense. But if you don't pair that with tax planning, you could maximize Social Security, but then ultimately hit that Social Security tax torpedo like Bill did. So I always recommend you need to bring tax planning and Social Security planning together. And what we do with our clients is we use a financial planning software that allows us to model out different Social Security scenarios. So if a client has options, we'll model out different scenarios. And then the software will take into consideration the potential tax impact of when you start taking Social Security. So again, that financial planning assessment is available to all of you. And you'll see the link has come up again in the bottom left-hand corner. If you want to talk about Social Security planning and you want to talk about how it impacts tax planning, we can certainly cover that during the financial planning assessment meeting. And we can talk about how we utilize some really cutting-edge software to help our clients make the best decisions. Okay, great question. Now let's move on to Medicare and taxes. Okay, we'll now look at how Medicare and something it calls IRMAA, IRMAA, can impact some couples in the go-go years and beyond. First off, what is IRMAA? It stands for Income-Related Monthly Adjustment Amount. The emphasis is on income because it is a monthly tiered surcharge, which is just another form of tax, that is taxed on to Medicare Parts B and D premiums. But it only happens if you have income over $91,000 for singles and $182,000 for married couples. Let's take a look at what this means in action. Let's meet George and Martha. They are a high-earning married couple, and both are Medicare Part B and Part D participants. IRMAA surcharges affect income from 2 years prior, and this couple was on track for $283,500 of modified adjusted gross income, or MAGI, in 2020. But on December 1st, 2020, George decided to sell a stock that he bought for $10,000 on July 1st, 2007. And he sold the stock for $11,000. The resulting $1,000 gain was taxed at the 15% long-term capital gains rate, which you would expect, plus an additional 3.8% net investment income surtax, for a total federal tax bill of 18.8%. That 3.8 net investment income surtax, by the way, is another tax that comes into play when your modified adjusted gross income exceeds $200K for singles and $250K for married couples. So George and Martha owe $188 of tax on the gain from their sale of stock, which is 18.8% of 1,000, right? Or do they? Remember, my definition, as I stated earlier, of a tax is any cost that increases as your income increases. So George and Martha will owe more than $188 because the gain from the sale of stock pushed them off the Medicare IRMAA cliff into paying higher Medicare premiums. So let's take a look at that. Look at this Part B IRMAA chart. That additional $1,000 gain pushed their AGI into the next premium tier that starts with $284,001. So now, instead of owing $340.20 each for their monthly Medicare Part B premiums, George and Martha will owe $442.30 per month, which is an additional $102.10 times 2, which gets you to $204.20, for an annual total of $2,450.40. Wow. But it's not over, because Medicare Part D IRMA charges are also impacted. George and Martha will each owe about another $19 per month for their drug plans, which is an extra $466 for the couple over the course of a year. Adding all the IRMA surcharges together for the year, George and Martha will each owe about an extra $121 a month, which is just under $3,000 for the year. Now, combine that with that amount with the $188 of federal income tax that they would owe on their stock sale, and the total tax on the $1,000 of gain, just $1,000 of gain on one stock, comes to $3,104. That is a tax rate of 310%. Let me repeat that, 310% tax rate. And that is why they call it the IRMA cliff. Now, let's move on and discuss Medicare enrollment, because making sure that you enroll in Medicare at the right time is also a critical decision. And if you make a mistake, you can be hit with a lifetime penalty. To help you understand, I want you to meet Jim and Ann, who are both 68. Jim retired at 65, and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offers retiree health benefits, which is a great perk. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. And even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann, didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the next year. In a worst case scenario, they might have resulted in a gap in coverage for Jim and Ann if they had a major medical need. But even in a best case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium for life. So you can see now how much that translates into real dollars. They owe an extra $408 in 2022. But historically, we know that premiums will be higher. So that 10% penalty will likely grow and grow. And over the course of a lifetime, that could translate into a $10,000 plus mistake for that couple. For simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so they won't have to sign up for Part D, but you should know that there's a penalty for that as well. Now we've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So if you're like some who have seen this presentation, you may be asking yourself, what other tax traps will we face in retirement? Well, the Social Security tax torpedo and the Medicare IRMA cliff are fairly unique because the public generally isn't aware of those tax squeezes. What we're going to see now is how the tax code in plain view can snag retirees, especially when there isn't proper planning, which brings us to our third key. One of the concepts that we often talk to our clients about is the tax bucket approach to retirement. And there are three buckets that we always talk to our clients about, and that is the taxable bucket, the tax-deferred bucket, and the tax-free bucket. And it's important to plan how you will use each bucket to manage your income and tax brackets efficiently. You can't be haphazard about tapping into your tax-deferred savings because timing is everything. And if you don't plan carefully through all stages of retirement, you'll encounter unintended tax consequences. This can have a major impact on how the taxes you pay in retirement, and now is a great time to pause for another poll. So I'm curious from the group, because we know that taxes can vary throughout different phases in retirement. But let's just talk about the next 5 years. Do you believe that taxes are going up or down in the next 5 years? We'll give everyone a moment or so to answer that poll. And yeah, it's pretty overwhelming here. It seems like most of you believe that taxes are going up in the next 5 years. And I agree with that because regardless of political outcomes, the Tax Cuts and Jobs Act, which went into effect in 2018 and lowered taxes for nearly all Americans, is set to sunset in 2026. So we actually have another presentation and some materials on the Tax Cuts and Jobs Act and the potential impact that it could have on retirees when it sunsets in 2026. And we're happy to provide that to you during our financial planning and assessments meeting. But for the sake of today's discussion, if you believe that taxes are going up in the future, it really could impact how you plan your retirement accounts today. And that's a great segue into our next slide, which discusses Roth IRA conversions. Roth conversions can be a great way to help you manage your income both before and during retirement. And a Roth conversion is a simple process that allows you to move money from an IRA or another pre-tax retirement account to a Roth IRA, which is after tax and allows for tax-free growth and withdrawals. And in general, the amount that you convert is added to your income for that year and will be taxed at your personal tax rate. So for example, if Jill converts $100,000 from her IRA to a Roth IRA, she will add $100,000 to her income for that year, and the conversion income will be taxed at Jill's personal tax rate. A conversion, though, doesn't need to be all or nothing. One helpful conversion approach is called filling up the bracket. And often you may find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself into a higher tax bracket. So for example, in 2022, the 22% tax bracket for married couples filing jointly goes from about $83,550 all the way up to $178,000. So you got a big area there, big bracket that we can work in. So if you file a joint return and your taxable income is $100,000, that means you could add another $78,000 of income without going into the next bracket. Making a Roth IRA conversion like that could make some sense. If you plan to convert a large IRA, this approach is often more efficient than converting the full amount in 1 year. Instead, you convert smaller Roth conversions over a number of years, filling up the bracket each year. This can help you to reduce the average tax rate you'll pay on your converted money, and it also spreads out the tax over a longer period of time. Now, let's open it up for a quick question here. Let's see what kind of questions have come in. This is a good one. All right. Mike asks, what is the best way to determine the right amount to have in each tax bucket and the right amount to consider each year for a Roth conversion? Really, really good question, Mike, and thanks for submitting it. And we've got a lot of good questions that have come in, so we appreciate those. So when figuring out the right amount to convert each year and when to do conversions, you want to look at your personal tax situation. So obviously, as I just mentioned, filling up the tax bracket is one of them. Just understanding how much available you have in your tax bracket for that year can be a simple way to look at Roth conversions and what's the right amount per year. But we also like to plan for the future. So with the financial planning software that I mentioned earlier, what we're able to do is model out the future. And we can look at what sort of exemptions, what changes in income you could potentially have as you progress throughout retirement. We model out what sort of growth you can expect in your retirement accounts. And all of that helps us to make educated decisions as to the right amount to convert per year. And this sort of software has some pretty complex logic behind it to help us calculate the right amount to convert. So in short order, again, when making conversions, you want to speak with a financial planning professional or a tax professional. But I really believe that utilizing a professional model is the best approach for any individual or couple when considering Roth conversions. So again, feel free to schedule your financial planning assessment if you haven't already, and we can walk you through that software. Some other tactics that I'd also like to mention that you could use in managing income around your tax brackets is withdrawing tax-free money from life insurance policies to keep your income low. We often talk about life insurance as a really nice supplement to your retirement accounts because it has some preferential tax treatment. Selling highly appreciated stock for low or no capital gains, and taking distributions from IRAs or 401ks to take advantage of a lower tax rate in a given year. And I'll give you one that's been very, very timely. In fact, we worked with a client last week on this specific example. So right now we know that the market's been down this year and quite significantly. So we had a client who owns a large amount of stock, which is actually a company that she worked for a number of years. She owns a large amount of that stock in her IRA. And she wanted to keep the stock because, the stock's been hit hard, just like most have this year. But we looked at it as a great opportunity to convert that stock to a Roth IRA. Why? We're still going to have to pay taxes on it. But we know that because that stock is at a lower level today, we're sort of converting it at a discount. And the hope is, this is a big, Fortune 500 company. The hope is that stock now will rebound in the future. And as it rebounds and grows, you have the ability to allow it to grow tax-free and then ultimately draw from that asset tax-free by converting it to a Roth. So really interesting planning opportunity right now with the, with the turmoil we've seen in the markets to be able to convert stock at a lower rate and then ultimately hopefully have it grow tax-free in the future if it's converted to a Roth. Now, there are two other pre-retirement strategies that you should consider, but they don't apply to all people. So we're not going to spend too much time on them today, but I do want to mention them. If you qualify for a high deductible health plan, you could consider a health savings account or HSA to help reduce your taxable income. Or if you own a business, you could consider a qualified business income deduction, also known as a QBI. And we can certainly talk more about those in the assessment meeting if they qualify for you. So now let's talk about charitable giving and taxes. This is one that I am very passionate about, as giving back is one of the core values of our firm. That said, we oftentimes see clients giving back in a manner that is not beneficial to their tax situation. So now let's take a look at this. We've seen throughout our presentation the critical importance of managing our tax-deferred accounts, because once you're over age 72, you're forced to take out required minimum distributions or RMDs, and that can be troublesome to your tax bill. But many people make charitable donations supporting their favorite causes with annual gifts. So let's take a look at how your RMDs combined with charitable giving may work with some proper planning. Meet Albert and Shirley, who are in the 24% tax bracket. Now, the standard deduction for married couples filing joint returns in 2022 is $25,900. But Albert and Shirley are over 65, so they get an additional deduction, bringing their total standard deduction for 2022 to roughly $28,700. This means they will receive no tax benefit for any itemized deductions unless their total exceeds that $28,700 mark. So if Albert and Shirley have $15,000 of existing itemized deductions, say from state and local taxes, medical expenses, and mortgage interest, what happens tax-wise if they donate $5,000 to a charity? Well, they get no federal income tax benefit from making the charitable donation because it doesn't exceed that $28,700 standard deduction. Now, that's not to say they shouldn't do it, but they should understand it's not going to help them on taxes. Now, if you're over age 70 and a half and you have an IRA or an inherited IRA, there's another way to give to charity than simply writing a check. It's called a qualified charitable distribution, or QCD for short. Let me explain how it works so you can see why a QCD can be very powerful. First, a couple of rules. If you're 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married and both of you are 70 and a half or older, and both of you have an IRA, you can each make a $100,000 qualified charitable contribution from your IRA. Second, any qualified charitable distributions you make count towards satisfying your required minimum distribution for that year, which begin at age 72. However, when you make the distribution from your IRA, it must go directly from your IRA to a qualified charity, or you could receive a check from the IRA custodian and make it payable to the charity of your choice. Third, even if you gave to the charity, you get no income tax deduction. So why would I suggest a strategy where you get no deduction for giving to charity? Probably all a little puzzled right now. Because when you make a qualified charitable distribution, the distribution from the IRA is never counted as income when you compute your taxes. So let's see how this helps Albert and Shirley. First, let's suppose Albert and Shirley do what many retirees would do. Albert takes his required minimum distribution of $5,000 at the beginning of the year and deposits it into the bank. He's done with his RMDs for that year. Now, being charitable people, they donate $5,000 to a nonprofit that they're passionate about. Pretty simple, but let's take a look more closely. By virtue of giving to the charity this way, Albert and Shirley's $5,000 charitable contribution will actually cost them a total of $6,200. Why? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% tax bracket, and 24% times $5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of their charitable gift is $5,000 plus $1,200 or $6,200. Remember, the gift didn't impact their standard deduction. The RMD behind the gift just added to their income. Ouch. Now, let's see what happens if Albert and Shirley use the QCD to give to the $5,000 charity. Instead of requesting a $5,000 distribution from his IRA go into his bank account, Albert would simply have his IRA custodian transfer the $5,000 directly from his IRA to the nonprofit. That then satisfies Albert's yearly RMD because he's now over age 72. Now, if the charity is in the same position as before, they receive the $5,000 donation, which is great for their cause. But Albert and Shirley are in a much better position. They still gave the $5,000 to charity. And even though they received no deduction for making a contribution, their IRA distribution is excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give to the charity was still $5,000. And that results in a $1,200 savings over the previous example simply by knowing how to use the tax rules to their advantage. And they did this without ever getting a deduction. So in short, we love to see when clients give back to charitable endeavors that they're passionate about. And we often meet with clients who are giving to charities regularly, but they're not getting the proper tax benefit from them. So I always say, let's make sure that we utilize the rules of the tax code to allow you to make charitable contributions and allow them to go further in the future, because more money is ultimately going to you and then hopefully to the charity down the line and less to taxes. But we all know that charity starts at home. So it's natural to ask, how does retirement tax planning figure into legacy planning? And it's a very good question because the government still wants its share of those tax-deferred assets when you pass away. And like we've seen, how you set things up really matters. And legacy planning is still very, very important, which leads us to key number 4, our final key. Organize your assets for your family's benefit, which is one of the key components of a custom financial plan because estate planning is very, very important. Now, let's briefly discuss long-term care. And believe it or not, there are a number of tax breaks associated with long-term care insurance, which is why we touch on it in this presentation. For example, long-term care premiums may be deductible medical expense at the federal level and even possibly eligible for deductions or credits at the state level. And on the other side, if you're receiving long-term care benefits In many cases, those benefits are tax-free. For instance, benefits received from reimbursement-style policies are tax-free. In addition, cash benefit-style policies are tax-free if they don't exceed the higher of your actual long-term care costs or the IRS daily limit, which is currently set at $390. Choosing how you pay for long-term care costs can have a major impact on your estate and ultimately your heirs. Okay, we're getting to the end of the program here, and you're probably thinking, goodness, how in the world will we ever manage this, Dan? And it's a very good question. So let's bring it all together. We started with a clear statement about the problem. Retirees often pay more in taxes than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. Let's do a quick review of what we learned about the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts to fill up your brackets, something you could do throughout your early retirement while you're in low-tax years. We also looked at Social Security and taxes, and we saw Medicare has its own tax-like structure that can push you off the IRMA cliff. We also saw the importance of signing up for Medicare on time right in the middle of those early go-go years. That's because starting in the middle of your retirement years, you'll be confronted with required minimum distributions, and we've seen the importance of planning your income needs before that. And then we saw the importance of setting up your assets and managing them during the later years of retirement so you can preserve the most for your heirs and leave them with the most tax flexibility. All of those items together lead us to the obvious solution to our original problem. Because your tax exposure will change throughout retirement, you need a strategy that anticipates how and when you tap assets to cover your personal expenses, understands the range of taxes you will face at various stages, and manages your assets so you pay as low a tax rate as possible. As I mentioned throughout today's program, we believe that building a custom financial plan using proper software that models all of this is the best approach to help you accomplish your goals. So you may be in one of the 4 phases of retirement that we discussed and at the beginning of the presentation: pre-retirement, early retirement, middle retirement, or late retirement. And managing your tax rate through the 4 stages of retirement is part of the challenge of financial planning. And we've seen the cost of mistakes. Naturally, we want to be efficient with our savings, and these are the strategies that can help reduce your tax burden. But as with many things in life, this takes education, planning, and advice. And it's a lot to think about. Our tax code is very complex, and the rules are continuously changing. But what doesn't change is the need for a plan. So that brings us to the next portion of our program, which I mentioned earlier, the complimentary financial plan assessment, where I look forward to meeting with each of you virtually to answer any additional questions that you have had from today's program and assess your specific situation to see if there are some areas of opportunity to limit your taxes. Additionally, as part of that call, we are going to give you access to 2 phenomenal resources to help you in your retirement planning journey. First, we will give you access to our retirement readiness calculator and starter plan, which gives a brief and simple overview of your current retirement readiness with some simple charts and illustrations, which you can see a preview of on the slide that's up right now. And secondly, we will give you access to our portfolio risk analysis and stress test tool. Now, this tool has been extremely popular as of late, given all the turmoil and volatility in the markets, because now more than ever, it is important to assess how much risk you are willing to take on and how much risk you are currently taking on in your retirement portfolio. Now, this tool will take a look at your specific situation through a simple questionnaire to help you assess how much risk you should be taking on. Many of you have probably taken a risk questionnaire in the past, but they tend to be very basic and generic. We love this tool because it gives each individual or family a specific risk number from 1 to 100, and it allows you to build a custom portfolio around that number. Now, the last thing that I will share with you before we take another question or two is a PDF which gives a brief summary, an overview of today's content. I know that we covered a lot today and in a pretty short period of time, and this PDF can serve as your cheat sheet moving forward as you take notes and look to digest today's content. Taylor is now posting that PDF in the document section of the webinar. So right next to the Q&A section, there's a handout section that'll allow you to download and save that document to your PC. So just look at that, the handout section where you can download that. And that brings us to the end of today's content. I think we've got time for one more question. So let's see what questions have come through. We've sent a lot through. I see Rich is working hard to answer your question. Thanks, Rich, and thanks to all of you for being very, very interactive and participating in today's program and sending through a lot of great questions. Like I said, we won't have a chance to answer all of them today, but we will make sure that we answer all of your questions after the program and during that financial plan assessment. So here is one question that comes to us from Kathy. Kathy says, you have mentioned several times this financial planning software. How does someone get access to this? Yes, Kathy, I have mentioned this several times, and I apologize for repeating myself, but I think it's really, really important because we're fortunate enough to now have great tools at our disposal. You know, a lot of these types of calculations that I mentioned when it comes to tax brackets and Social Security and filling up Roth buckets, all of that used to be very, very manual. And today we're fortunate to have software that models all of that out for us. And the answer is there are some simple tools that you can probably find online. I've seen some of them. But in order to get access to the best financial planning software, you need to work with a financial planner. So many of you may already be working with a financial planner and have a plan in place that you're comfortable with. And if that's the case, great. I commend you on that. And our financial plan assessment meeting will simply be a second opinion. Okay. That'll give me the opportunity to give you a second opinion. But if you're comfortable with the plan you have in place and you are happy with the financial planner that you're working with, then I think that's amazing. And I hope you continue to do great work with them. If you don't have a plan in place that you're comfortable with and you're not working with a financial planner, we urge you to do so, whether it be with us or someone else that is right for you and your family. We can help to make a recommendation on that, and we can certainly cover that in our follow-up meeting. In closing, I want to refer back to our mission statement, which I referenced earlier, and that is to provide educational resources to hardworking individuals and families to help them to accomplish their life goals. And I really hope that today's program provided you some educational resources to help you all to achieve your life goals. Thank you for being with us today. Thank you for helping us to further our mission. And we look forward to meeting with you in a time very, very soon to help you to continue to plan and develop a plan to win the game of retirement. Thanks very much. Be safe and be well.